Welcome to this real estate finance exam prep session, designed to help you master the key finance concepts tested on the real estate exam. In this video, we'll cover types of loans and mortgages, the loan application and qualification process, government loan programs, underwriting, and more. Be sure to like and subscribe so you don't miss future exam reviews, and don't forget to watch the lower corner. What shows up there could give you a real advantage on test day. Let's jump in.
Real estate finance. Types of loans and mortgages. What is a fixed-rate mortgage? Is it A, a mortgage with a fixed interest rate for the loan term? B, a mortgage with an interest rate that fluctuates monthly? C, a loan with no interest rate? Or D, a mortgage that can be refinanced anytime without fees? The answer is A, a mortgage with a fixed interest rate for the loan term. Fixed-rate mortgages have a consistent interest rate throughout the term, offering predictable monthly payments. This stability makes them popular among long-term homebuyers. Source: National Mortgage Licensing System. Which of the following best describes an adjustable-rate mortgage? Is it A, a mortgage with consistent interest rates? B, a short-term loan with no interest charges? C, a mortgage with interest rates that adjust periodically based on an index? Or D, a loan that can never be refinanced? The answer is C, a mortgage with interest rates that adjust periodically based on an index. Adjustable rate mortgages have interest rates that vary based on a financial index. This can lead to changes in monthly payments, often starting with a lower initial rate. Source: Federal Reserve's Consumer Information.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
What is a major benefit of a VA loan? Is it A, it requires a large down payment? B, it offers reduced closing costs and no private mortgage insurance? C, it is only available for investment properties? Or D, it is exclusive to first-time homebuyers? The answer is B, it offers reduced closing costs and no private mortgage insurance. VA loans, backed by the Department of Veterans Affairs, benefit eligible veterans by offering reduced costs and no requirement for PMI, easing financial barriers to homeownership. Source: U.S. Department of Veterans Affairs. Which type of loan allows for an interest-only payment option? Is it A, interest-only mortgage? B, conventional fixed-rate mortgage? C, government-insured mortgage? Or D, graduated payment mortgage? The answer is A, interest-only mortgage. Interest-only mortgages allow payments solely on interest for a preset period, reducing initial costs but without principal reduction during that time. Source: Consumer Financial Protection Bureau. What characterizes a balloon mortgage? Is it A, a revolving credit agreement with no set maturity date? B, a mortgage that fully amortizes over 30 years with no large payments? C, a loan designed to gradually increase payments over time? Or D, a mortgage that has a large final payment due at the end of the term? The answer is D, a mortgage that has a large final payment due at the end of the term. Balloon mortgages feature lower monthly payments with a lump sum balloon payment at term's end. This structure can be risky if not planned for appropriately. Source: Federal Housing Finance Agency. What is a characteristic feature of a fixed-rate mortgage? Is it A, interest rate varies over time? B, interest rate remains the same over the loan term? C, loan term is always 15 years? Or D, payments decrease over time? The answer is B, interest rate remains the same over the loan term. Fixed-rate mortgages have an interest rate that remains unchanged over the life of the loan, offering predictability in monthly payments. This contrasts with adjustable-rate mortgages. Which of the following is true about an adjustable-rate mortgage? Is it A, the interest rate is locked for the entire duration of the loan? B, the interest rate adjusts periodically after an initial fixed period? C, they are only available for short-term financing? Or D, they guarantee a lower overall interest cost than fixed-rate mortgages? The answer is B, the interest rate adjusts periodically after an initial fixed period. ARMs have an initial fixed rate period, after which the interest rate adjusts periodically based on agreed indices and terms specified at the outset. What describes a balloon mortgage? Is it A, it requires large upfront payments followed by smaller ones? B, it offers a graduated payment schedule that increases periodically? C, it includes a large final payment to pay off the debt? Or D, the interest rate adjusts frequently throughout the loan term? The answer is C, it includes a large final payment to pay off the debt. Balloon mortgages feature regular payments during the loan term, similar to interest-only loans, with the balance due at the end in a single lump sum payment. What is a reverse mortgage primarily designed for? Is it A, first-time homebuyers to access home financing? B, senior homeowners to convert home equity into cash? C, investors looking for income property financing? Or D, homeowners looking to refinance at lower rates? The answer is B, senior homeowners to convert home equity into cash. Reverse mortgages allow seniors to access home equity as cash. They are typically used by homeowners aged 62 and above to supplement retirement income.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
In which scenario is a jumbo loan most likely required? Is it A, purchasing a home with a high market value exceeding conforming limits? B, buying a modest starter home within standard market limits? C, refinancing a small suburban home to reduce interest rates? Or D, acquiring a rural property with government-backed financing? The answer is A, purchasing a home with a high market value exceeding conforming limits. Jumbo loans are used for home financing when the purchase price is above the conforming loan limits set by the Federal Housing Finance Agency, typically needed in high-cost areas. Which type of mortgage allows the borrower to pay an interest rate subject to change at specified times over the loan term? Is it A, fixed-rate mortgage? B, adjustable-rate mortgage? C, interest-only mortgage? Or D, balloon mortgage? The answer is B, adjustable-rate mortgage. An adjustable-rate mortgage features an interest rate that adjusts periodically based on an index reflecting the cost to the lender of borrowing on the credit markets. What is the primary feature of a reverse mortgage? Is it A, the borrower receives monthly payments from the lender? B, the borrower pays a variable interest rate and monthly principal? C, the borrower is required to pay only interest for an initial period? Or D, the borrower needs to refinance every 5 years? The answer is A, the borrower receives monthly payments from the lender. A reverse mortgage allows homeowners, typically senior citizens, to convert part of their home's equity into income without having to sell the home or make monthly payments. What distinguishes a jumbo loan from conventional loans? Is it A, it offers a lower down payment option? B, it provides government insurance against default? C, it exceeds conforming loan limits set by the FHFA? Or D, it guarantees low monthly interest payments? The answer is C, it exceeds conforming loan limits set by the FHFA. Jumbo loans exceed the conforming loan limits established by the FHFA and are not eligible for purchase by Fannie Mae or Freddie Mac, typically requiring higher credit scores. Loan qualification and application process. Which of the following is not considered when determining a borrower's debt-to-income ratio? Is it A, monthly rent payments, B, student loan payments, C, car loan payments, or D, child support payments? The answer is A, monthly rent payments. Only applicable monthly debt payments and obligations, such as loans, credit card payments, and alimonies, are considered in the DTI ratio. What is the main purpose of the loan application, commonly known as Form 1TEZ-03? Is it A, to estimate property value, B, to document the borrower's financial information, C, to set interest rates, or D, to finalize the purchase agreement? The answer is B, to document the borrower's financial information. Form 1003 collects detailed borrower information, including assets, liabilities, and employment history, to assess loan qualification. What does a lender primarily assess when conducting an underwriter review? Is it A, real estate trends, B, property location, C, market interest rates, or D, borrower's credit score? The answer is D, borrower's credit score. Underwriters focus on the borrower's ability to repay the loan, which is significantly influenced by their credit score, income, and DTI ratio. Which document outlines the interest rate, loan amount, and monthly payments in detail? Is it A, purchase agreement, B, loan estimate, C, appraisal report, or D, credit report? The answer is B, loan estimate. A loan estimate is issued by lenders to illustrate the terms of the loan, aiding borrowers in understanding and comparing loan offers. Which factor directly affects the interest rate a borrower pays on a mortgage? Is it A, neighborhood facilities, B, property size, C, borrower's credit score, or D, time of year? The answer is C, borrower's credit score. Lenders use the borrower's credit score to assess risk. A lower score typically results in a higher interest rate due to perceived risk. What is the primary benefit of a pre-qualification letter when applying for a mortgage loan? Is it A, it guarantees loan approval, B, it gives an estimate of the loan amount you might qualify for, C, it locks in the interest rate for the mortgage, or D, it is required to make an offer on a property? The answer is B, it gives an estimate of the loan amount you might qualify for. A pre-qualification letter indicates how much a borrower might be able to borrow based on a preliminary review of financial data. It's an initial step, distinct from pre-approval. Which document is typically required during the mortgage loan application process to verify employment history? Is it A, credit report, B, W-2 forms, C, bank statements, or D, property title? The answer is B, W-2 forms. Lenders often require W-2 forms as proof of employment and income. This helps them assess the borrower's capacity to repay the loan. Why is a credit score important during the mortgage loan qualification process? Is it A, it determines property value, B, it verifies employment, C, it estimates property taxes, or D, it affects loan approval and interest rates? The answer is D, it affects loan approval and interest rates. Credit scores reflect credit-related behaviors and influence lenders' decisions on loan approvals and the setting of interest rates. What is the purpose of a debt-to-income ratio in the loan qualification process? Is it A, to set the down payment amount, B, to assess the borrower's ability to manage monthly payments, C, to determine the property's market value, or D, to verify legal ownership of assets? The answer is B, to assess the borrower's ability to manage monthly payments. The debt-to-income ratio compares a borrower's monthly debt payments to their income, indicating their capacity to take on additional debt from a new loan.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Government programs. What minimum down payment is required for an FHA loan? Is it A, 10%, B, 5%, C, 3.5%, or D, 15%? The answer is C, 3.5%. FHA loans require a minimum down payment of 3.5% for borrowers with a credit score of 580 or higher. This makes homeownership more accessible for those with lower credit scores. Which of the following is a feature of a VA loan? Is it A, no down payment required, B, strict income limits, C, only for new home purchases, or D, available to all U.S. citizens? The answer is A, no down payment required. VA loans are a benefit provided to veterans, allowing them to purchase a home with no down payment, making it easier for them to achieve home ownership. What is a key eligibility requirement for a USDA rural development loan? Is it A, property location in a rural area, B, maximum loan amount of $300,000, C, 20% down payment, or D, minimum income of $50,000? The answer is A, property location in a rural area. A USDA rural development loan requires the property to be located in a designated rural area to qualify, allowing for no down payment for eligible buyers. Which program offers mortgage insurance to protect lenders against borrowers' default? Is it A, conventional, B, U.S. Department of Veterans Affairs, C, U.S. Department of Agriculture, USDA, or D, Federal Housing Administration, FHA? The answer is D, Federal Housing Administration, FHA. FHA loans come with mortgage insurance that lowers the risk for lenders, thereby empowering them to lend to more individuals. What is the maximum seller concession allowed on an FHA loan? Is it A, 3%, B, 6%, C, 9%, or D, 10%? The answer is B, 6%. FHA allows seller concessions up to 6% of the purchase price, helping buyers cover closing costs and lowering the overall expense burden. Which government program is specifically designed to assist veterans in obtaining housing loans? Is it A, Federal Housing Administration, FHA, B, U.S. Department of Veterans Affairs, C, U.S. Department of Agriculture, USDA, or D, conventional? The answer is B, U.S. Department of Veterans Affairs. The VA loan program, provided by the U.S. Department of Veterans Affairs, offers benefits such as no down payment for veterans, active duty service members, and certain military families. Which government program offers loans to low-income households for properties in rural areas? Is it A, Federal Housing Administration, FHA, B, U.S. Department of Veterans Affairs, C, U.S. Department of Agriculture, USDA, or D, conventional? The answer is C, U.S. Department of Agriculture, USDA. The USDA loan program aims to improve quality of life and boost economic development in rural America by offering affordable mortgage options to low and moderate income applicants. What is a primary feature of an FHA loan? Is it A, zero down payment, B, low down payment, C, no mortgage insurance, or D, limited to veterans? The answer is B, low down payment. FHA loans, insured by the Federal Housing Administration, require a lower down payment compared to conventional loans, making them accessible to first-time and low-income buyers. Which program requires private mortgage insurance if a buyer puts less than 20% down? Is it A, Federal Housing Administration, FHA, B, U.S. Department of Veterans Affairs, C, U.S. Department of Agriculture, USDA, or D, conventional? The answer is D, conventional. Private mortgage insurance protects lenders on conventional loans when the buyer puts less than 20% down to lessen lender risk in case of default by the borrower. Which characteristic is unique to USDA loans compared to FHA and VA loans? Is it A, available to all buyers, B, geographic eligibility requirement, C, fixed interest rates, or D, provided to veterans? The answer is B, geographic eligibility requirement. USDA loans have a unique geographic eligibility requirement, restricting the program to properties located in designated rural and suburban areas to stimulate rural development housing. Mortgage markets and regulatory bodies. Which federal entity is primarily responsible for overseeing the mortgage market and ensuring the safety and soundness of the financial system? Is it A, Federal Reserve Board, B, Consumer Financial Protection Bureau, C, Federal Housing Finance Agency, or D, Federal Deposit Insurance Corporation? The answer is C, Federal Housing Finance Agency. The FHFA oversees Fannie Mae and Freddie Mac, ensuring the efficient functioning and safety of the mortgage market. What is the primary purpose of the Real Estate Settlement Procedures Act? Is it A, to regulate interest rates on mortgages, B, to require disclosure of closing costs and eliminate kickbacks, C, to determine mortgage eligibility criteria, or D, to set maximum loan amounts? The answer is B, to require disclosure of closing costs and eliminate kickbacks. RESPA ensures that homebuyers receive disclosures about the real costs of the settlement process and prohibits kickbacks in real estate transactions. Which agency enforces regulations related to consumer credit protection in the mortgage industry? Is it A, Securities and Exchange Commission, B, Federal Trade Commission, C, Consumer Financial Protection Bureau, or D, Office of the Comptroller of the Currency? The answer is C, Consumer Financial Protection Bureau. The CFPB oversees and enforces federal regulations regarding mortgage credit education, ensuring transparency and fairness for consumers. What does the acronym QM stand for in the context of mortgage loans? Is it A, qualified mortgage, B, quick market, C, questionable mortgage, or D, quantitative margin? The answer is A, qualified mortgage. Qualified mortgages are loans meeting specific standards and providing protections to lenders and borrowers, reducing risk of lender losses from defaults. Which type of mortgage entity purchases loans on the secondary market and is regulated by the FHFA? Is it A, credit unions, B, Freddie Mac, C, retail banks, or D, mortgage brokers? The answer is B, Freddie Mac. Freddie Mac is a government-sponsored entity that buys residential mortgages, thus providing liquidity in the mortgage market, and operates under FHFA regulation. Which regulatory body oversees the mortgage-backed securities market in the United States? Is it A, Consumer Financial Protection Bureau, B, Federal Reserve, C, Securities and Exchange Commission, or D, Federal Housing Finance Agency? The answer is C, Securities and Exchange Commission. The SEC regulates the securities markets and protects investors, making it responsible for overseeing mortgage-backed securities. This ensures transparency and legal compliance. What is the primary purpose of the Federal Housing Finance Agency? Is it A, manage the national housing financing systems, B, create housing policy, C, regulate Fannie Mae and Freddie Mac, or D, insure mortgage loans? The answer is C. Regulate Fannie Mae and Freddie Mac. The FHFA is tasked with overseeing Fannie Mae, Freddie Mac, and the Federal Home Loan Bank system to ensure stability in the U.S. residential mortgage markets. How does the Federal Reserve influence mortgage interest rates? Is it A. Direct mortgage pricing, B. Setting the federal funds rate, C. Legislating mortgage rates, or D. Buying mortgage loans? The answer is B. Setting the federal funds rate. The Federal Reserve can affect mortgage interest rates by adjusting the federal funds rate, which indirectly influences lender rates and mortgage market conditions. What role does Ginnie Mae play in the mortgage market? Is it A. Originates mortgage loans, B. Provides mortgage insurance, C. Sets mortgage rates, or D. Guarantees government-insured mortgages? The answer is D. Guarantees government-insured mortgages. Ginnie Mae is a U.S. government corporation that guarantees the payment of principal and interest on mortgage-backed securities issued by approved lenders of government-insured loans.
Don't forget to comment below with your tips, challenges, and thoughts on exam preparation. Your experiences can make a big difference for others.
Underwriting. What is the primary purpose of underwriting in real estate finance? Is it A. To assess the property's market value, B. To determine the risk of the loan application, C. To forecast market trends, or D. To secure insurance for the loan? The answer is B. To determine the risk of the loan application. Underwriting involves assessing the loan applicant's ability to repay the loan and the risks associated with the loan. It is a critical step to protect the lender. Which factor is typically analyzed during the loan underwriting process? Is it A. Credit history of the borrower, B. Weather trends in the area, C. Annual property festival schedules, or D. Architectural style of the property? The answer is A. Credit history of the borrower. Underwriters evaluate the borrower's credit history to assess the likelihood of loan repayment. A strong credit history suggests lower risk for the lender. How does a debt-to-income ratio impact underwriting decisions? Is it A. It helps to set interest rates, B. It indicates the borrower's financial health, C. It evaluates the property's location risk, or D. It predicts future real estate trends? The answer is B. It indicates the borrower's financial health. The debt-to-income ratio helps underwriters determine a borrower's ability to manage monthly payments and repay debts, thus indicating financial stability. Which of the following is not typically considered by underwriters? Is it A. Borrower's employment history, B. Borrower's hobby preferences, C. Property appraisal value, or D. Borrower's income level? The answer is B. Borrower's hobby preferences. Underwriters focus on factors that influence loan repayment risk, like income, credit history, and employment stability. Personal hobbies are irrelevant. Why is verifying a borrower's income important in the underwriting process? Is it A. To estimate loan value improvements, B. To ensure compliance with anti-money laundering laws, C. To assess repayment capacity, or D. To determine neighborhood crime rates? The answer is C. To assess repayment capacity. By verifying the borrower's income, underwriters can assess their capacity to make monthly payments and manage the financial demands of the loan. Which of the following is a primary concern of an underwriter when assessing a mortgage application? Is it A. The applicant's marital status, B. The applicant's credit history, C. The local real estate market trends, or D. The geographical location of the property? The answer is B. The applicant's credit history. The applicant's credit history is vital in evaluating their creditworthiness and ability to repay the mortgage, forming the basis for approval or denial that adheres to federal lending guidelines. What is the maximum debt-to-income ratio commonly accepted by underwriters for conventional loans? Is it A, 25%, B, 36%, C, 50%, or D, 60%? The answer is B, 36%. Most underwriters allow for a maximum front-end DTI ratio of 36% for conventional loans, ensuring the borrower can manage debt repayments comfortably without undue hardship. When assessing property value, what is the primary method used by underwriters? Is it A, owner's historical purchase price, B, cost approach, C, income approach, or D, comparative market analysis? The answer is D, comparative market analysis. Underwriters rely on comparative market analysis to evaluate property value, comparing similar, recently sold properties to establish the fair market value for the mortgage application. During the underwriting process, what is a key indicator of the applicant's ability to repay the loan? Is it A, loan-to-value ratio, B, credit score, C, appraised property value, or D, property location? The answer is B, credit score. Credit scores are critical as they summarize credit behavior, helping underwriters determine the likelihood of timely loan repayment based on past performance and lending criteria. Loan closing and costs. Which document is most critical for detailing all costs associated with closing a real estate transaction? Is it A, deed, B, closing disclosure, C, promissory note, or D, purchase agreement? The answer is B, closing disclosure. The closing disclosure is essential as it itemizes all costs involved in the transaction, providing transparency to both parties about fees and charges in compliance with federal regulations. What is typically included in a buyer's closing costs? Is it A, loan origination fees only, B, down payment, C, title insurance, loan origination fees, and appraisal fees, or D, property tax for the next year? The answer is C, title insurance, loan origination fees, and appraisal fees. Buyers' closing costs often include various fees such as title insurance, loan origination, and appraisal fees, alongside other potential charges like inspection fees and prepaid interest. Why is a title search conducted during the real estate closing process? Is it A, to appraise the property's value, B, to establish property boundaries, C, to uncover any liens or encumbrances on the property, or D, to finalize the mortgage rate? The answer is C, to uncover any liens or encumbrances on the property. A title search ensures that the property is free of encumbrances, such as liens or claims that could affect the new owner's title and right to use the property, protecting the buyer and lender. What is the primary role of escrow in a real estate transaction? Is it A, to guarantee the sale price, B, to hold and manage funds until all conditions of the sale are met, C, to determine property taxes, or D, to perform home inspections? The answer is B, to hold and manage funds until all conditions of the sale are met. Escrow is a neutral party that holds funds and documents during a real estate transaction until all contractual conditions are met, ensuring secure and fair dealing between the buyer and seller. How many days in advance must lenders provide the closing disclosure to borrowers prior to closing? Is it A, 3 days, B, 1 week, C, 10 days, or D, on the day of closing? The answer is A, 3 days. The closing disclosure rule under the TRID mandates a 3 business day period before closing, ensuring borrowers can review and understand the final terms and costs of the mortgage. What is the purpose of an escrow account in real estate transactions? Is it A, To hold the buyer's earnest money until closing. B. To provide an additional line of credit for the buyer. C. To ensure the seller's mortgage is paid off before transfer. Or D. To accumulate funds for future property improvements. The answer is A. To hold the buyer's earnest money until closing. Escrow accounts are used to hold earnest money and other funds until all sale contingencies are satisfied, ensuring both parties fulfill their respective obligations. Which document itemizes the costs and transactions between parties in a real estate closing? Is it A. The purchase agreement, B. Closing disclosure, C. The property deed, or D. The title insurance policy? The answer is B. Closing disclosure. The closing disclosure, which replaced the HUD-1 settlement statement for most transactions, includes a detailed account of all financial transactions, ensuring transparency and accuracy. Why is a closing disclosure statement delivered to the borrower before closing? Is it A. To review property's title history, B. To renegotiate the real estate commission rates, C. To provide a copy of the property's appraisal report, or D. To confirm the final loan terms and costs? The answer is D. To confirm the final loan terms and costs. The closing disclosure gives the borrower a chance to review all final loan terms and closing costs, fulfilling legal requirements for informed consent before signing. Who is typically responsible for paying the lender's title insurance policy during a real estate closing? Is it A. The buyer, B. The seller, C. The real estate agent, or D. Both the buyer and seller? The answer is A. The buyer. The lender's title insurance policy is generally covered by the buyer because it primarily protects the lender's stake in the event of title issues. Which closing cost is typically not negotiable between the buyer and seller? Is it A. Loan origination fee, B. Recording fees, C. Real estate commissions, or D. Appraisal fee? The answer is B. Recording fees. Recording fees are determined by local governments to cover the costs of entering property information into public records, making them typically non-negotiable.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Taxation and assessment. What is the primary purpose of property tax assessments? Is it A. To determine a property's market value for sale, B. To calculate the mortgage payment for property owners, C. To fund local amenities and services through taxation, or D. To verify compliance with zoning laws? The answer is C. To fund local amenities and services through taxation. Property tax assessments are conducted to determine a property's taxable value, ensuring local governments receive revenue to fund schools, infrastructure, and essential services. Which factor can influence a property's assessed value for taxation? Is it A. The property's rental income, B. The property's location, C. The owner's credit score, or D. The color of the property's exterior? The answer is B. The property's location. Property location affects its assessed value, as proximity to amenities and services can increase demand and thus higher tax assessments. How often are property tax assessments typically conducted? Is it A. Every 5 years, B. Annually or biannually, C. Once at the time of purchase, or D. Every decade? The answer is B. Annually or biannually. Property tax assessments are typically conducted annually or biannually to ensure tax levels reflect the property's current market value. What happens if a property owner disagrees with a property tax assessment? Is it A. They can apply for a refund, B. They have to wait until the next assessment cycle. C. They must immediately pay a fine. Or D. They can file an appeal with the local tax board. The answer is D. They can file an appeal with the local tax board. If property owners disagree with a tax assessment, they can file an appeal with their local tax authority to seek a reassessment or adjustment. Which of the following is not typically a criterion in determining a property tax rate? Is it A, local government budget needs, B, national economic performance, C, public services expenditure, or D, number of taxable properties in the area? The answer is B, national economic performance. While local fiscal needs and public service costs impact tax rates, national economic conditions typically do not have a direct effect on local property tax rates. Which of the following is a federal tax benefit of owning real estate? Is it A, deducting mortgage insurance premiums, B, capital gains exemption for primary residences, C, exempting rental income from taxation, or D, claiming depreciation on land value? The answer is B, capital gains exemption for primary residences. The federal tax code allows a capital gains exemption on the sale of a primary residence for qualified homeowners, providing a notable tax benefit. How is the assessed value of a property typically used in real estate transactions? Is it A, to determine the property's sale price, B, to establish the property's insurance premium, C, to calculate annual property taxes, or D, to set the amount of a loan secured by the property? The answer is C, to calculate annual property taxes. Assessed values are calculated by local assessors to determine property tax amounts, not for setting sale prices or insurance.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.